Tom Lee just dropped some pretty big news for investors. He just gave you an overview of his expectations for this entire year. Now, to be fully open, honest, transparent with you guys, I was in the shower. Yeah, it's kind of weird, I know. But when I heard this clip, I knew you guys had to hear it as soon as possible. So I threw on whatever I could find. This hoodie literally has paint on it from when I painted the house. Didn't even put the hat on yet, go figure. You need to hear this. We're also going to be going over what the Fed just did and why stocks reacted the way that they did, and ultimately what could be coming next in the near term for our markets.
We are still seven months out from the election. It's going to feel like 10 years, but it's only 7 months. But of course, wild speculation is already in full swing. And now the former guy, last name Trump, is starting to close the gap in some of the online prediction markets. Yes, the odds on political betting market predicted still show President Biden with a lead. But that lead is down a bit from a couple of weeks ago. And since the election really does only come down to about 5 or 6 states, we also got to look there. And the latest polling from Morning Consult showing that the former president leading in all but one of those so-called battleground states. Now, some polls will be different, but there you go. Of course, we are CNBC. So we're not doing this for just political reasons. Others do that. We mention it because it could matter to the markets and your money. Trump has said he wants lower interest rates. I mean, he is a real estate guy after all. And President Biden wants to let the entire 2017 tax cuts expire, which would jack up taxes on everyone if he is unable to redo it and carve out a provision for people making under $400,000. Remember, he said that, but it's not a sure thing. The whole thing expires. You have to start from scratch. And in the stock market, defense stocks keep moving up as the real risk of war is rising in the Middle East. Again, this is not a political segment. We'll leave that to others. But the election could certainly matter a lot to the markets, the economy, and your money. Joining us now is managing partner and the head of research at Fundstrat Global Advisors, Tom Lee. Again, not an advocate for one or the other. But if we start to see a shift, what will shift in the market?
Well, as you point out, markets, investors have to think about, well, things could change in November. And to me, two areas that are obvious would be, I think oil prices would likely be lower because there'd be more drilling. Mm-hmm. So I think energy stocks would come under pressure. I think healthcare would come under pressure as well. And you should see a commensurate lift in groups like industrials. And, as you talk about the Middle East war ramping up, oil should be going up, and it's not. So in a way, the fact that energy's done poorly does tell us something else might be at work.
Yeah, and I think that's kind of what we're looking at. It's an excellent point, right? And you talk about maybe we somehow get to 15 million barrels a day in oil. Well, you're probably looking at $60, $65 oil.
Yep, that's right. Lower oil is great for consumers, but it does mean lower prices for oil, and it wouldn't be great necessarily for the energy complex.
And the president has said, now here's the disconnect. The president's people will say, and the president himself has said sometimes, I'm going to, let the tax cuts expire for everybody but those making over 400,000. But the problem is that that's not how it works. It's an act. It's a rule. The whole thing has to expire. Then you have to start from scratch. And the president has said a number of times, and his team has posted it to Twitter, he's going to let the whole thing expire. So if we're facing down the barrel of higher taxes for everybody at the end of next year, minus the SALT deduction cap, which I wouldn't mind seeing going away, by the way, personally, then what?
Yeah, and it's not only could tax cuts expire, but I think investors worry about a new plan that might include much higher capital gains taxes as well. So I think that's...
You've talked about that.
Yeah, and I think that's going to send obviously a big chill to markets as well.
And higher corporate taxes. But our corporate taxes, which they're always like this boogeyman, people don't realize that corporate taxes, while important, are a small part of federal tax revenue. That said, they matter to the companies themselves. Would higher corporate taxes mean lower stock prices?
There's going to be an optical confusion for investors because, European corporates have much lower statutory tax rates. So over time, investors are going to look at U.S. and they're going to have earnings and they have to say, well, should I adjust the multiple because the tax rates are higher? But ultimately, it's not great for stocks because uncertainty creates discounts.
Do you expect the markets, I know you're still optimistic, still bullish, right? And you've been right. You've been long and strong and correct. Do you think we're going to kind of see what we saw in 2016, which is like a summer of nothing from the stock market? Summer is a slower time anyway.
Yeah.
But when you got this election, And the two are within a percent. Some polls are up, some are down. It doesn't matter. It's going to be close. We know that. Do you expect this? People just say, you know what, selling may go away because I don't know what's going to happen in November.
Yeah, I think it is probably a three-phase year. I think we're still in the up phase, so maybe May, June, we still rally. But I do think there's going to be a period of doldrums and adjustment. And then we rally, I know, sometime in the back half of the year. So I do think that middle part could be flat to down.
Damn, Tom Lee. The middle of the year is going to be flat to down. I think I need a drink. So brisk tea for that. This stuff is actually pretty nasty. 97% of your daily sugar. 49 grams of sugar in. Okay. That's gotta go. What Tom Lee just said is important. Let's not try to get too political here because we're not about politics. Have your personal biases and keep them where they are. Politics normally do not change anything, okay? Whether it is a Republican president, a Democratic president, no matter if, one president, let's call it Republican, controls the Senate, the House, the presidency, or it's a Democrat. It doesn't matter, okay? Markets historically have performed actually better under Democrats because they tend to spend more money, and markets typically like that. This time around, though, there's just different policies, like polar opposite in terms of the policy structure that is being campaigned, right? Let's just call it for what it is. T-Man, he wants lower taxes, lower rates, more of a deglobalization, bring things back to the U.S., or at least that's what we hear. Biden, kind of the same thing, the deglobalization, aka as well, it's probably good you know this, that's pretty inflationary, deglobalization, and it can create a more hostile world long term. But you have B-Man over here that wants to raise taxes on corporations, capital gains taxes. There are some actual implications here. If you have a lot of money, if you are a billionaire, if you do own a lot of stock, there is implications there. Depending on who wins, you may benefit from whatever side that you are on. Now, I don't really care about that too much. That can eke into the markets. So as the polls start to shift, it is certainly possible. You could envision a market that could start to react more to political headlines. And that is certainly possible. We have seen that happen in the past. I don't really care about that too much, though. I think if you are an investor in stocks, what Jerome Powell just said told us a lot today. But the number one thing you want to be watching for throughout 2024 is, are we going into a recession or not? That's it, okay? Stocks are fairly valued. They're not cheap. You can make an argument they're expensive. But I would say they're just sitting at fairly valued. As long as you don't go into recession, as long as the economy stays well, and as long as people stay employed and continue to spend money. And right now, according to Fed Jerome Powell, that's kind of what he's seeing. Fed Jerome Powell said if you exclude the inventory numbers out of quarter-over-quarter GDP, which came in really low last week, then you actually seen a GDP number coming in over 3%, which suggests the economy is still doing well. And that is good for stocks. Take a stroll down memory lane. You remember 2022. At least I hope you do. It was a pretty rough year. Why? We didn't have a recession. Earnings sure went down a little bit, like $20 on the S&P 500. Whoop-de-dang-deuce. Big deal. The problem was everyone thought we were going to go into a recession. It was by the end of 2022, the start of 2023, mid-year 2023, the end of the year 2023. Markets kind of got over that now. You don't really have anyone that's calling for a recession these days. And that's usually when a recession does come. Now, if you think back to your most recent recessions, let's call it the dot-com bubble, that was mainly fueled by speculation in stocks that were unprofitable. It would be like meme stocks on steroids, okay? And most of your stocks were meme stocks back in the dot-com bubble. Of course, that was going to end in tragedy. That was, I mean, you could have seen that from a mile away. And people did at the time and made money from it. If you think about the dot-com bubble, what happened? Banks started to go under. You know, the Fed, the government was too late to bail out certain institutions. And, well, people lost their jobs. That's what happened. That was the central catalyst. Lehman Brothers and Bear Stearns. Lehman Brothers was earlier in the year, I believe March of 2007. And then Lehman Brothers was September 15th, 2007. And that was when everything came crashing down following Lehman Brothers. If you think back to the latest recession that we had, it was the Rona. Now, in the past, 24 years, let's call it, you haven't seen a recession start out of nowhere. So I think you want to be on watch for any kind of centralized event that could cause a recession, because to be quite honest, I think we're overdue for one, since we have really not had a real recession to flush out excess, risky investments or bad investments since really 2008, 2009. It's been a long time. Now, during an election year, you're probably not going to get a recession. 2025 could be a bigger problem. Now, as Tom Lee said in that clip, the middle of this year could be problematic. Now, I don't think it's going to be that bad. Like, it's not going to be a 2022 situation unless the economy starts to look like it's getting worse. And then at that point, the Fed's going to start cutting rates, and then we'll have to make the assessment of how bad's the economy going to get, where's the Fed funds rate going to be. That's really a topic for down the line. Okay. The Fed is not worried about stagflation. They're not worried. Jerome Powell said, I don't see the stag or the flation. Dude's got too much swag up there on the podium. He sounded very confident and very bullish. Here's the deal, though. If we do get a little bit of weakness in the economy, in which that's kind of my expectation as you head into this summer, one area of the markets specifically will rally, because a little bit of weakness, well, not a terrible thing, but it gives the Fed a reason to start cutting rates. So I think with markets fully valued, you're not getting any discounts on there. You're not getting any stocks on the S&P 500 broadly that are trading at huge discounts, at least not on, your big tech basis. I think the small caps would be the area to really win in that environment, especially if you did get the polls starting to favor T-Man. And, that would mean likely lower rates to go. Remember what T-Man told Jerome Powell back in 2018. He said, cut rates or you are fired. And what happened about a month or two later, Jerome Powell started cutting rates. So I think... kind of trying to leave out the politics here, but I think politics can start to have an effect on the markets, like Tom Lee and what they were talking about on CNBC. So I don't think a big crash is coming anytime soon, unless you do get a black swan event and kind of an outsized, bad catalyst. I don't think you're entering into stagflation. I do think inflation will continue to come down, as the Fed said, but it's going to be bumpy. I do think, though, if we get into that kind of environment where you see a little bit of weakness and some rate cuts, and maybe T-Man starts to take the lead in all of the polls, then I think your small caps can start to do very well. But I think when Tom Lee is talking about this, as he did today, he's really referencing the S&P and the NASDAQ on a headline basis. You guys got to keep in mind that you could have 90% of stocks doing well on our markets if all of your big tech was selling off, your Mag 7, the markets wouldn't do much of anything. And in that scenario, if you had, let's say, Microsoft, Google, Amazon, Apple, Nvidia, Meta, all of those big tech stocks, let's say they were down 2% in a single day, you could have every other stock in the markets go up 2% in a day, and you would still have the S&P and the NASDAQ red. That just shows you kind of the weighting in the markets. Now, in a theoretical example here, because we don't know what's going to happen, but if indeed you do start to see some weakness in the economy and the Fed starts to cut rates, big tech is not the area of the markets that benefits from rate cuts. It is the small caps. That's the bottom line. You could actually make an argument that big tech may benefit from rates being higher for longer because all of their billions and billions and billions of dollars in the bank collects them more free money. If rates start to fall, that starts to go away, and that's problematic. So, long story short, I'm not expecting new all-time highs this year. Tom Lee is bullish. He's not necessarily calling for new all-time highs this year, but I'm not expecting all-time highs. I do think you can chop around, trade sideways for a bit, whoop-de-whoop-de-doop, spin in circles, blah, blah, blah. But you probably do get more downside heading into this summer, as you did in 2016. If you do get some outsized upside, it's probably going to be in those small cap stocks. In my personal opinion, that's where I think the risk to reward investing in our markets right now makes a lot of sense. Keep in mind, later on today, you will have Apple earnings, and that will be very important for the markets. And then coming on Friday morning, you are going to get the non-farm payroll report as well as the unemployment rate, and we'll see what happens there. I really don't think it matters too much as long as you come in line with expectations. Expectations for non-farms are sitting at about 240,000 job ads for the month of April. If you come in higher than that, that could be a little problematic for markets. But again, people employed, that's likely going to mean good earnings this year. If you come in under 200,000, that's going to be great news. If you come in under 120,000, 130, 140,000, then the markets might start to panic a little bit more and say, that's a great deal of weakening in the labor market. Same thing is true with the unemployment rate. That's expected to come in at 3.8%. If that were to rise to 4%, that would be a new high for at least the past year, and that would not be great. If you go higher than 4%, that's where the Fed starts to kind of watch and see like, hey, maybe we should start the process of reducing rates. And again, that does benefit the small cap stocks. So maybe even coming by this Friday, I wouldn't count it out, but small caps could be the outperformer for the rest of this week. And you can see in after hours, IWM was the outperformer. So let me know what you think about this information down below in the comment section. Hit the like button as well as subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.